John-Paul, a very warm welcome. So in plain English then, what exactly changes versus the current exemption? Who suddenly pays tax?
So, this is a very important question to start with. I mean, for general South Africans, not a problem at all, because we don't generally have foreign pension funds. Those, however, who have worked abroad, earned foreign pensions, and those who are foreign individuals coming into South Africa are going to bear the brunt of this change. So essentially, currently what's happened is we exempt foreign pension funds under certain conditions, Social Security, for example, and compulsory, let's say, contributions via employment, similar to South Africa. That is taxed under, like you say, tax treaties. They want to change that to be based on tax residency. So essentially what was previously non-taxable in South Africa is going to be totally taxable, subject to tax treaties, obviously. That's in layman's terms of what essentially is going to be happening.
And John-Paul, are there any groups that might be excluded by these treaties? I understand that it hits returning South Africans and foreign retirees. Does anyone catch a break here?
Well, if you have a foreign pension fund, quite simply, and you trigger, firstly, if you have left and are returning and you re-trigger tax residency, this will be applicable to you. If you are coming to South Africa as a foreign individual, just because you're entering South Africa and spending a little bit of time here, might have an investment property, etc., it doesn't affect you. But if you're triggering tax residency, it will then have a severe impact on you. So in terms of those who catch a break, it's those who at least know how to navigate tax residency. Outside of that, the only other saving grace you have is your respective tax treaty. And they do differ country to country, for example. So very important.
Government, as I understand it, says the aim is to stop, and I quote, double non-taxation. Practically, how big a problem is that? And would double taxation still occur despite DTAs?
So, excellent question. And this is an incredibly problematic scenario we're currently facing. I mean, I deal with individuals entering into the country all the time and have to advise on their structure and what their tax implications are. So UK, as there's a big export of South Africans to the UK individuals love coming to South Africa. So their DTA, for example, is one that is problematic. That allows for double non-taxation. The treaty will say you pay tax on your pension where you are tax resident. So if they are they leave the UK, come to South Africa, trigger tax residency here, our domestic local South African tax law says, but we exempt that. So actually, that individual who's coming here to retire is really winning because he's not paying any tax on that. So in terms of the change, I mean, we've got individuals who have set up their life. Retirement is a very important aspect of life. And it was actually one of the most critical things in terms of the wealth tax discussion, by the way, is how do we deal with the retirement funds? It's almost meant to be, if I could say, sacred. So now we've got individuals who've entered the country, set up their life, and all of a sudden, on which might to them be very short notice, next year there could be implementation of all of a sudden their foreign pensions being taxed. Separately, those individuals who are, and I'm talking real examples who I've consulted with this week. I mean, we're talking incredibly wealthy individuals from around the world, head of big corporate banks, etc., want to retire in South Africa. And based on this amendment, they actually have changed their mind.
Well, that's exactly it. I mean, there's a real downside here. There is a warning that wealthy retirees might not choose South Africa. Difficult, though, to quantify the potential loss of investment and spend. It's really about the optics, which you've pointed out.
Correct. So, I mean, it really is. Firstly, it will come down to tax treaties. Bearing in mind, we'd still first consider local tax law. But if there's another tax treaty, such as, let's say, New Zealand, that would say New Zealand has the right to tax it, then we'd have to consider the international tax treaty. As in our law, we are also compelled to consider that too. So it doesn't mean it's a be-all and end-all, but it does mean that there initially will be double tax. And secondly, it is about the optics. Perhaps there's other countries, for example, Belgium has one of your highest tax rates on income. There's other countries who maybe you're happy to be a South African tax resident to pay tax on your foreign pension and rather pay here than there, for example. So it really does depend on the optics, like as you said, Jeremy.
Is there any policy alternative that might protect South Africa's attractiveness without opening loopholes?
Well, I think for the time being, you need to consider your tax treaty. That really is the most important thing at this stage. Wherever you are a tax resident, bearing in mind at this stage, if you are still, one of the first most important things, if I must say, Jeremy, a lot of South Africans have not formalized their non-tax residency. So they are living abroad for, let's say, 20 years. I mean, the longest one I've done is I've backdated a non-residency application to 1987. So there's individuals all around the world who are unaware that now they'll be paying tax on their foreign pensions because they've not formalized their non-tax residency with SARS. So that's the starting point. Secondly, I mean, maybe not something you can, a policy change, but I mean, generally your retirement funds and specifically the wording in your double tax treaties, it covers pensions, retirement annuities, and all similar income. So it really is entirely encompassing of those kind of policies. So if you're talking about a specific policy, unfortunately, not really. There's no real way around this removal of this exemption in that sense.
And John-Paul Fraser, tell me about timeline. When does all of this bite? And at this point, would there be transitional rules for people already drawing a foreign pension?
So the first and most important thing is comments are open. Obviously, we live in a democracy, and this involves the National Treasury as well as SARS. So comments on proposed amendments, closure is 12 September. I mean, it's just over 2 weeks, 3 weeks away. So I do encourage everyone who can, please do submit comments. As you note, this is incredibly short notice because this does take effect next year from the 1st of March. That is very short notice for people who have planned their entire life for something, and to be given, let's say, a couple months' notice that all of a sudden their plans are not really applicable anymore. It's a very scary thing to do. So, comments firstly, and then secondly, alternative to that is where you can, try consult a tax specialist, specifically cross-border tax specialist. This is a very niche area of law. So tax treaties are incredibly important because that's, like I said, whatever that dictates doesn't mean that just because SARS wants to tax your foreign pension, that your now treaty is all of a sudden irrelevant. So that's a very good starting point, if I may say.
And just a quick one, assuming this does go through, and there's every likelihood, are there specific documents that SARS will expect?
Well, the scary thing, and this is a whole other topic, Jeremy, is what's currently going on as we speak is the OECD, which is the international organization that actually runs our current treaty models, as well as the African tax organizations, various of them, all working on the automatic exchange of information. So whether you provide documents to us or not, once a year, there's going to be an automatic exchange between tax authorities on individuals. So generally, like normal tax, you would have to submit source documents, income source documents, a source of funds, etc. But even if you don't, the scary thing is what's currently happening behind the scenes is that not very long from now, even if you don't, it's going to be automatically provided and exchanged to SARS. So just to be aware of that as well.
John-Paul Fraser from Tax Consulting SA, thank you very much.